So just by switching from debt to equity, we were able to make this deal a lot more attractive. And one of the things that we were able to achieve since our last call was we did this land deal around the corner from us out here in Scottsdale, and it was a vacant piece of land. It's considered vacant land because there's not a building on it. And what we did was we were able to talk to the owner. He's got some tenants out there paying rent on it, and the total rent that they're making is about $12,000 a month. So we talked to him about buying it. It makes $144,000 a year, and that's net. It says gross, but it's actually net because there's no utilities. There's no expenses out there except to pay, land taxes. And on vacant property, taxes on vacant land is very low. So what we did was we came up with a negotiation face to face with the guy about it, and decided that his price of $1.5 million was fair. We wanted him to carry that $500,000, and then we also wanted to actually bring the utilities into the property. Know that part of this is due to the fact that in the future we plan on building in this property. So what we did was we asked the seller if we could bump the purchase price up to $1.75 million, and what we would do then is go and borrow $1.25 and have him seller carry $500,000. That would look like to the bank or to the borrower that we're going after that we've got $500,000 in equity, because the seller, is going to do that seller carryback after or as what is called a secondary lien position. He'll let us hang out with $500,000 in debt, and it'll look like we've got some money and skin in the game because we've got this amazing term with this guy. The seller would then give us $250,000 at closing. When he takes the 1.25, he's going to give us $250,000 of that, so we can get those utilities done and get the work done on the property that'll get it ready for development in a couple of years. So we'll actually land bank this for about 2 years and suck all the depreciation out of it that's available. And once we get all that, then what we'll do is we will renegotiate with our tenants on other vacant lots, move them out to those vacant lots, and put a building on this property. So when we go after investors, we can actually give them more money back than they would get in other investments without going bankrupt. So I figured that out and came up with a way to do that, which then increased our debt service coverage ratio to 3. So just by switching from debt to equity, we were able to make this deal a lot more attractive. So I wanted to make sure that if I'm going to go after an investor, they understand the exit, because investors want to know the exit. Banks typically don't care about the exit, but an investor definitely does. So I made sure to write up this deal where we're going to do 8 units on this property, and it would be in about 3 years. We would go out there and build a 40,000 square foot commercial industrial space condo, and by building it out, you can see here, we can very easily rent it out, create an income from that building that would then make an asset value of almost $8 million to $10 million. So our investors who came in at 1.25 are going to be able to exit at 8 minimum.